Hello, clients, friends, and colleagues. This is Rich Siegel with ARQ Wealth Advisors. Today is Saturday, March 6th, and it's time for another brief market and economic video. Well, this past week was quite volatile in the markets. One of the main themes was that interest rates rose fairly dramatically over the last week or two. You'll notice here from this top chart, the purple line is the 10-year Treasury yield, and it's been climbing pretty steadily since the middle of last year. In recent weeks, we've spiked here to about 1.56%, which is historically quite low, but quite high relative to the last couple of years. And you'll notice relative to the 2-year Treasury, this spread has widened. And that's a good thing. Treasury bonds should have a positive yield and should pay investors a dividend. Now, the trajectory of this and the steepness of it has put a little bit of fear and volatility in the markets. And the rationale here is that with a heating up economy and another round of fiscal stimulus coming into play, that will have significant inflation. Jerome Powell just said a couple of days ago that he does expect a transitory period of inflation. They're going to let it happen, and it should be short-lived. Okay. Now, when rates go up, bonds go down. So this is a very interesting chart here. The U.S. Aggregate Bond Index, the green line, this is year to date, is down about 3%. That's a fairly big drop for bonds. And the reason here is these are very high quality issues, and they have an inverse relationship to yields. So if yields go up, bonds go down, and vice versa. One of the areas I like to highlight here that we have a lot of our investors' money in is liquid non-traditional investments. That's the blue line. So these are liquid alternatives, if you will, and they have similar volatility metrics to bonds without the interest rate sensitivity. So this is an area that we like a lot, and over the last couple of years have added some money into this part of the capital markets. Now, conventional thinking says that if rates go up too high, it's bad for stocks. And that's true. And at some point, if the 10-year Treasury is yielding 4, 5, 6%, they start to compete with stocks. Why would you put your money at risk if you could earn 5% risk-free? But again, we're at 1.56%. This chart here is pretty interesting. It goes back to the 60s and shows that in periods of rising rates for the 10-year Treasury here, okay, overall, stocks do quite well. So you can see here, for example, let's go back a decade or so, July of 2012 through 12/31/13, about a year and a half or so. Okay, over 17 months, rates increased by 1.6%. Okay, and during that time, the S&P 500 was up 30+%. Overall, in these periods, the stock market has averaged up 17%. So we're not concerned that stocks are going to lose money if rates go up, especially if rates go up in a methodical way. And again, a steepening yield curve shows that the economy is strengthening. This is a healthy development. Okay. The last thing I'll focus on here briefly is the stock market. I created my own little index here called FANG plus T. And FANG stands for Facebook, Apple, Amazon, Netflix, Google, and the T is Tesla. So I took this group of 6 stocks, which are now a very large percentage of the S&P 500, over 20, 25%. And I looked back a month. And the reason why I did a month is because that's really when rates started to move up quickly. You can kind of see here. Here's a month right there. And during this time period, you'll notice that these tech stocks have pretty much gotten hammered, down 10%. That's a pretty big drop in 1 month's time. But what I'll draw your attention to is the cyclical areas of the market. XLF is an ETF that tracks the financials. XLE is energy. And XLI is industrials. These sectors are all economically sensitive sectors. They tend to thrive in a new economic expansionary phase, which we are in now for sure. In fact, by all measures, we're looking at a pretty decent GDP for this year, probably in the 5 to 6% range at a minimum for the whole year. That's 2 or 3 times as high as it's been for the last couple of decades. So keep in mind what's been working for the last several years, big cap tech stocks, the Apples, the Microsofts. That's great. But the problem is they're all trading at very high valuations now. I would look back at a month, 6 weeks, and call this a mini bubble. We're not surprised. These stocks should not be trading at 30, 40, 50, 60, 100 times earnings. That's very high. This is the stay-at-home trade. When you're locked in your house, this is what's worked. Now we are reopening. And when you reopen, there's going to be pent-up demand for dining out, for traveling, which is good for the energy sector, jet fuel, auto fuel, et cetera. So we believe that we're in a shift here from large cap tech being the big winners to the more cyclical, economically sensitive stocks that have underperformed for years as the new leaders of the stock market. I hope you enjoyed this quick video. Have a great day and a great weekend.